So we will continue our discussion on the pilot paper where the question number 3 is actually touching upon the ESG framework as well as how it gets connected to capital budgeting like payback and all. So we will first read the question and get an understanding and then see how we can attempt to it. So I'll read out the question for you. It's there available on the screen as well. Serendip Private Limited or SPL, a manufacturing company, is considering investing in a solar-powered energy system for its main production facility. So they are investing in a solar-powered energy system. Now, if you had gone through my ESG framework and sustainability video, I'm talking about this example a lot, solar-powered energy system. Is it environment friendly, a greener technology, saving of electricity cost? At the same time, you are giving back to the grid as well if there is any excess. So it's all like into sustainability. A perfect example. Sorry. They are considering investing in a solar powered energy system for its main production facility as part of its long-term sustainable strategy. The proposed investment requires an initial capital outlay of 48 million. An initial capital outlay of 48 million. Initial capital outlay is 48 million. So this is a project evaluation combining ESG framework. So this is the additional thing that has come up. We'll have a project life of 8 years. Project life of 8 years. It is expected to reduce annual electricity costs by 9 million. At current tariff rates, it says, at current tariff rates, okay. At current tariff rates, electricity costs by 9 million. Okay. Additional information given. From year 3 onwards, electricity tariffs are expected to increase by 2 million per year. Okay. From year 3 on at the current tariff rates, it's reducing the annual electricity cost by 9 million. But after 3 years, from third year onwards, tariffs are expected to increase by 2 million per year. The company expects to incur annual maintenance cost of 1 million throughout the project life. Okay. Annual maintenance cost is going to be 1 million throughout the project. Company expects an annual reduction of 500,000 in the CSR related cost as a result of this project. So that's a benefit. Company expects an annual reduction of 500,000 in corporate social responsibility. CSR stands for corporate social responsibility related costs as a result of this project. The government has agreed to provide a subsidy of 500,000 per annum for the first 5 years for using solar energy. For the first 5, it has a life of 8 years. But for the first 5 years, we are going to get a subsidy of 500,000 per annum from the government as a motivation, as an appreciation for using solar energy. At the end of year 8, the solar system is expected to have no residual value. No residual value at the end, so no scrap value. Investment is also expected to reduce carbon emissions significantly, enhance the company's environmental reputation. Those are like non-financial factors. Reduce the carbon emissions significantly, enhance company's environmental reputation, support compliance with emerging environmental regulations. Support compliance with emerging environmental regulations. Okay, compliance with emerging environmental regulations. Right, so those are like non-financial but can indirectly affect your finances also. However, these sustainability related benefits are difficult to quantify in monetary terms. Difficult to quantify in monetary terms at the moment. You are working as the management accountant of this company. Describe how the, okay. These are difficult to quantify in monetary terms. You are working as the management accountant of this company. Describe how the payback period may be adjusted. when evaluating sustainability related investments at SPL. Determine the payback period of this project incorporating sustainability related financial factors. Okay. Describe how the payback period may be adjusted when evaluating sustainability investment at Serendip Private Limited. Okay. Describe 3 marks, right? So the key word is highlighted and given in bold. Describe. Then part B, determine the payback period. Okay. Right. So the adjusted payback period that you have to mention there is for the part A, right? For the part A, this pilot paper. Question number 3, part A, about the adjusted payback period. So you might get at the exam an adjusted NPV. That can come. Don't expect the payback period payback period may be the easiest out of all computations, but you might get an NPV. So be ready for that. You know how to calculate NPV, but including these sustainable factors. Right? Now, the adjusted payback period modifies the cash flows of SPL using the payback calculation to reflect sustainability factors rather than altering the calculation method itself. Right? It modifies cash flows of SPL used for payback calculations, right, to reflect sustainability related factors. To reflect sustainability related factors rather than modifying the entire payback period. How you calculate is the same way. If it is NPV for an example, how you calculate is the same way. IRR even how you calculate is the same way. But what modifies is the cash flow. Certain new cash flow might come in, certain existing cash flows might get changed. That's what we are doing. Rather than altering the calculation method itself, adjustments in this scenario, right? Rather than altering the, rather than instead of altering or changing, my words are like, sometimes too advanced, some students have told me, I don't know, altering or changing the calculation method. අපි calculation method එකේ වෙනසක් වෙන්නේ නැහැ. cash flow තමයි පොඩ්ඩක් වෙනස් වෙන්නේ මේ environmental and social cost මේ ටික especially environmental cost මෙතෙන්දී consider කරාම modified cash flows you get. Okay. Okay, adjustments include right? One thing, future electricity tariff increases, additional annual saving comes up from year 3 onwards. So you need to explain that how payback period may be adjusted. What we are going to do If you really want, you work out part B and answer for part A in a question like this, that's fine, right? That will be easier for you, right? A, increase in electricity tariff from year 3 onwards, gives you additional annual saving of rupees 2 million per annum. Additional annual saving of rupees 2 million per annum. Okay. Then they are also talking about the company expects to incur annual maintenance 1 million throughout the project life. Annual maintenance cost is going up, right? Yeah. Annual maintenance cost $1 million is an incremental cost. Incremental cost because of this project. Incremental cost because of this project. Incremental cost because of this project. So that's either increasing cash outflows. If you want, you can write it as it increases cash outflows. Increases annual cash outflow. Or in other words, you can say reduces net cash inflow. Reduces net cash inflow, right? Reduces net cash inflow. Okay. Then there's another thing given, CSR company expects an annual reduction of 500,000 in corporate social related costs as a result of this project. CSR cost going down. CSR cost going down, I'll write in short form just to save the time. 500,000 per annum, CSR cost reducing 500,000 per annum. It's a positive impact on the net cash inflow. Government has agreed to provide a subsidy of 500,000 for the first 5 years. For the first 5 years, net cash flow increases by rupees 500,000 per annum. Rupees 500,000 per annum. Rupees 500,000 per annum. So non-monetary benefits are there mentioned in the question. Few non-monetary benefits were mentioned in the question. Investments are also expected to reduce carbon emissions significantly. Non-monetary factors reduce carbon emissions significantly, enhance the company's environmental reputation, support compliance with emerging environmental regulations. So all these three, difficult to quantify in monetary terms, it says yes, but these benefits can influence the management decision to accept the project despite a moderate payback. Even if the payback is moderate, there can be favorable factors for accepting. If it is a very short payback, definitely you will accept. If it is a moderate term, if you are on a doubt, these can be positive impacts, right? Non-monetary sustainability benefits, in short form I will write. Three, I'm not going to write down in detail, but if you want, you can write it down. Only 3 marks, no? Sustainability benefits may be difficult to be quantified, may be difficult to be quantified, difficult to be quantified, difficult to be quantified. However, they may create a positive impact for management to accept the project even if the payback period, even if the payback period is moderate. If it's a shorter payback period, definitely we accept. If it's a moderate payback period, we may have a doubt whether to accept or not. But these non-monetary benefits are definitely going to get crucial in favor of accepting the project. So this is what you need to write. More than enough for you to get 3 marks. So part B for 7 marks, determine the payback period. Determine the payback period of this project, incorporating sustainability related financial factors. Incorporating sustainability related financial factors, right? Okay, so with that, we'll work out the revised cash flow and see what the payback period is. Yeah. So what we get is companies considering, okay, yeah, part B. Year 0, the cash flow is, sorry, initially the initial capital outlay of 48 million. in rupees millions. Okay, rupees millions. In rupees millions. 48 million. We'll have a project life of 8 years. It is expected to reduce the annual interest cost by 9 million at current tariff rate. At current tariff rates, it's going to be 9 million. So I'll have a separate working for this. Working number 1. But it says from the third year onwards, it's also expected to increase by 2 million per year. Okay. Year 1 to year 2. 9 million is the electricity tariff saving. Electricity tariff saving. But year 3 onwards, it will be 11. From year 3 onwards, electricity tariff is expected to increase by 2 million. The company expects to incur an annual maintenance cost of 1 million throughout the project life. Annual maintenance cost. Annual maintenance cost is 1 million per annum. 1 million per annum. Company expects an annual reduction of 500,000 in corporate social responsibility CSR related costs. Right? Reduction of CSR cost. Positive thing. Reduction of CSR cost. 0.5. 0.5. Why I'm going for this? Because at the end of the year, it's residual. And it says the government has agreed to provide a subsidy of 500,000 per annum for the first 5 years. Subsidy, government. Government subsidy comes 0.5, 500,000. In millions, I'm giving. All figures are in rupees millions. If you want, you go with thousands. So year 3 to year 5, I will get year 6 to year 8. Year 6 to year 8 also 11. This continues. 1 million throughout the project you have. Reduction is CSR cost as a result of it. So throughout the year you will have it. Throughout the year you will have it. Subsidy is applicable only for the first 5 years. This won't come. At the end of the year, no scrap value. No scrap value. So the net cash flow we calculate. NCF stands for net cash flow. NCF stands for net cash flow. 9 minus 1 plus 1. It will be 9. 11 minus 1, 10 plus 1. It will be 10. Sorry, 11 minus 1 plus 1 is 11. I'm sorry. Eleven minus 1 plus 0.5, it will be 10.5. So these are the figures you are going to get for your cash outflow. Year 1 to 2, it's 9. Year 3 to 5, it's 11. Year 6 to 8, it's 10. 10.5. So we get the cumulative cash flow. Or you put it as year 1, 2, 3, 4 like that we'll put. That is easier. That is better for you to understand. 1, 2, 3, 4, 5, 6, 7, 8, 9, 9, 11, 11, 11, 10.5, 10.5, 10.5. So we'll go for the cumulative net cash flow. Cumulative net cash flow. Starting off with minus 48 plus 9 minus 39 plus 9 minus 30. What do you do? If you can remember the story, you plus this. Minus 39 plus 9. Previous year cumulative net cash flow plus this year's cash flow. minus 19 plus 11, minus 8 plus 11, 3. You can stop at that point. So adjusted payback period is like, during this year, 5th year, your cash flow is 11. 11. Out of that, you had to payback period is where it became 0. Cumulative cash flow became 0. Payback period. Okay. So how do you calculate the payback period? Let me show you. Here itself, I'll do it. Payback, now this computation is separate. Payback period equals, it's more than 4 years, less than 5 years. 4 years plus 4 years plus 4 years plus. How much we needed? The gap here was 8 minus 8 to 0 means 8. Total gap was 11. So what do you do? 8 divided by 11 into, if you multiply by 12, you get months. If you multiply by 52, you get weeks. If you multiply by 365, you get days. So I'll multiply by 12. 8 divided by 11 multiplied by 12, 0.8.7. Okay. 4 years and 8.7 months are almost equal to 4 years and 9 months. Or you can multiply by 365. If you multiply it by 365 instead of 12, 8 divided by 11 into 365, you get 265 days or 266 days. 4 years and 266 days. 270 days is almost 9 months. So that's fine, right? So if you want, you give it in terms of days. Okay, I hope that is clear. So your exam question may not be the payback period, but can be an NPV or an IRR incorporating these CSR activities, environmental or social costs and benefits involved. So here it's mainly on environment. So I'll move on to question number 5 before question number 4. There's a reason, because we covered the environmental costs aspect, ESG framework and the governance. So this is highly possible to be tested at the exam. So I want you to pay some attention on that. I'll read out the question for you. You are the corporate management accountant at Green Wave Manufacturing Private Limited. Corporate management accountant at Green Wave Manufacturing Private Limited, a company producing industrial chemicals for the regional market. Okay, Green Wave Manufacturing company producing industrial chemicals for regional market. I don't have the, due to some reason this is not working properly, so I'm doing underlining, but at your exam you use the highlight or use your one of the pens to underline. Industrial, producing industrial chemicals, right? Okay, for regional market. The company has committed to integrating sustainability principles into its management accounting practices. Integrating sustainability principles, what we studied in the previous video, right? Into its management accounting practices. with a practical focus on environmental, social, and governance (ESG) considerations to support long-term business value creation. Particular focus on environmental, social, and governance are the ESG considerations to support long-term business value creation. So, you see, it's in line with what we discussed. During the current financial year, an accidental chemical spill occurred at one of the company's production facilities. This is one of the case studies that we discussed. Accidental chemical spill occurred at one of the company's production facilities. Not intended but accidental chemical spill. One of the company's production facilities. The incident raised concerns regarding environmental compliance, operational disruption, and reputation risk. Incident raised concerns regarding environmental compliance, operational disruption, and reputation risk. Concerns regarding, okay, one is that the compliance of laws and regulations, external failure cost, operational disruption, internal failure cost, reputational risk in front of the market and customers and society. Your reputation is at a risk. Senior management has requested an internal report that clearly identifies the full environmental cost of the incident rather than allowing these costs to be absorbed into the general overheads. Get a report on full environmental cost rather than they get hidden or absorbed in the general overheads. Sorry. As the management accountant, you are expected to act as a gatekeeper, ensuring that all relevant sustainability related costs are transparently captured. All relevant sustainability related costs are transparently captured and used to inform future operational costs and investment decisions. Now, it's about the integrity of data integrity and information integrity we talked about. All relevant sustainability related costs are transparently captured and used to inform future operational controls and investment decisions. The following information is available in relation to the chemical spill. The cleanup contractor invoice, cleanup person, the outsourced person, 885,000 inclusive of 18% value added tax. VAT is recoverable. So VAT won't be a problem, no. So VAT is not a net cost. So 885,000 will be the cost. Environmental regulatory fine 350,000, same as the case study that we discussed. Lost raw materials 500 liters at a purchase cost of 2,000 per liter, of which 50% is recoverable under the insurance cover. That part was not there in the case study that we discussed. 500 into 2,000 you get. Okay, insurance cost, there's a net cost is only 50%. Sorry. Overtime labor hours used for spill response 80 hours at 500 per hour. Overtime labor hours to clean the spill or something. You had to use your labors, not just the contractor, right? You might need the support of your labor. Production downtime resulted lost in contribution from 1,000 units of production at 6. So that's another additional contribution foregone or an opportunity cost. Relevant cost again. Calculate the total environmental cost of chemical spill for internal reporting purposes. Describe how identifying the reporting these costs supports the incorporation of sustainability and ESG criteria into management accounting and business value creation. Discuss the gatekeeping role of the management accountant in promoting ethical, transparent, and sustainability focused decision making following the environmental incident. So 4 marks are given for the calculation, 6 marks for interpreting the theory, describe and discuss. So we'll have to be mindful on that aspect. There's a 40 to 60%, 50 to 50% balance between the theory and the calculation. Okay. Right. So first of all, we'll do the calculation. Right? First of all, we'll do the calculation. This 885,000 is inclusive of 18% VAT. The VAT is recoverable, right? Okay. Right. So we'll start off with all the environmental costs that we need to get. Cleanup contract invoice or cleanup costs. Question number 5. Part A. Cleanup cost net of VAT. Net of, because VAT is recoverable, no, that won't be a real environmental cost, because whatever the VAT portion for any supply, when we pay VAT, if it is recoverable, it won't be a part of your net cost. So 885,000 you need to divide by 118 multiplied by 100. 18% is the VAT percentage, no, they are telling. Divide by 1.18, 850,000 or 885,000 divided by 1.18, 750,000. 750,000 rupees. This is coming in rupees. Mention the currency also. Environmental regulatory fine imposed by, so that's an external failure cost again. Environmental regulatory fine by the authority, CEO, whatever. Environmental regulatory fine, okay, is 350,000. 350,000. 350,000. Yeah. Loss of raw material. Loss of raw material, 500 liters at a purchase cost of 2,000 per liter, of which 50% is recoverable. Right? Insurance claim 50%. Okay. Lost raw material will be 500 liters multiplied by 2,000 per liter, you get 1 million. Insurance claim is 50%. Insurance claim is 50%. So balance 50% is your cost. Therefore, 1 million into balance 50% is the cost. Balance 50% is the cost. Now let's say insurance claim was 40%. You have to get 60% as your cost. 500,000. Right? You may get a different percentage at the exam, right? If the insurance company gives only 40%, 60% will be our cost. If the insurance company gives us 70%, 30% will be our cost. So that is 500,000. Overtime labor hours used for spill response, 80 hours at 500 per hour. Labor overtime used for spill response. Labor overtime. Labor overtime was 80 hours at 500 per labor hour. 80 hours at 500 per labor hour. 80 into 500, 40,000. Production downtime resulted in lost contribution from 1000 units of products at 600 per unit. Production downtime resulted in lost contribution from 1000 units of product at 600 per unit. Lost contribution from 1000 units of product at 600. So lost contribution is a contribution foregone is an opportunity cost, which is a relevant cost. Okay. Lost contribution is an opportunity cost. Opportunity cost. Contribution foregone is an opportunity cost. Opportunity cost. Avasthita pirivayan sinhala small days economics. Okay. Thousand units of product at 600 rupees per unit. 1000 units into 600 per unit. 600,000. 600,000. So you get the total. Total environmental cost. Total environmental cost. Okay. Total environmental cost. How much is that? We will add up. 750 plus 350. 750 plus 350 plus 500 plus 40 plus 600. Save your time, all are in thousand. Save your time. 2,240,000 rupees. 2,240,000. On the top, we have put rupees. We have to put rupees. I think it was there. I changed this thing. Right, so calculate the total environmental cost for chemical spill for internal reporting purpose. It's 2.25 million without getting it hidden among the general overheads. Sorry. Part B of the question, describe how identifying and reporting these costs supports the incorporation of sustainability and ESG criteria. How identifying and reporting these costs supports the incorporation of sustainability and ESG criteria into management accounting and business value creation. Identifying and reporting these costs supports the incorporation of sustainability and ESG criteria into management accounting and business value creation. Right. So how කොහොමද මේ හඳුනා ගැනීම, how identifying and reporting these costs supports incorporation of sustainability and ESG criteria into management accounting and business value creation. E aspect is environmental, explicit recognition of cleanup cost, material losses and regulatory fines highlights true environmental impact of operational failures, right? True environmental impact of operational failures. Governance aspect is there. Transparent reporting prevents environmental costs being hidden in overheads, strengthening accountability and regulatory compliance. Business value creation is there. Accurate environmental cost data enables management to justify investments in preventive controls, safer processes, and cleaner technologies, reducing the risks and long-term costs. I repeat. E aspect Identifying and reporting environmental costs, supporting sustainability and ESG integration. Identifying and reporting environmental costs, supports sustainability, and ESG integration by environmental or E aspect. In the ESG framework, the E aspect, I'm going to write down not going to write down the full thing. Explicit recognition of cleanup cost. We recognized cleanup cost. What are the things we recognized here? Cleanup cost, environment regulatory fine, labor overtime, lost RM, lost contribution, right? Cleanup costs, material losses, lost raw material losses, regulatory fines. Those are all like environmental costs. Environmental impact on operational failures. These are like environmental impact on operational failures. Operational failures. Okay, operational failures. G aspect, the governance. 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 G aspect, the governance. Transparent reporting prevents environmental costs from being hidden in overheads, strengthening accountability and regulatory compliance. Transparent reporting. So this gives us transparent reporting, which is fundamental in management accounting, being the gatekeeper, and data integrity, where no hidden costs, right? Because of that, no hidden environmental costs. Okay. Strengthening accountability. These are keywords. Strengthening accountability. Accountability and regulatory compliance. Governance aspect. So there's a hidden governance aspect also we are studying, even though we are not going to governance on that aspect. And regulatory compliance. Okay. Business value creation, the third point. BVC, business value creation. Long-term value creation, short-term value creation. BVC. Okay. How do you cover that? Accurate environmental cost data enables management to justify investments in preventive costs, safer processes and cleaner technologies, appraisal costs, reducing future risks and long-term costs. Accurate Because it says discuss, 3 points are given, at least 3 points you need to write down, 3 marks. Accurate environmental cost data helps, okay, helps management to be justified. That part I don't write. Investment in preventive costs, how to prevent environmental costs. So that's also part of environmental cost. Preventing this kind of incidents. Safer processes. Chemical spill can cause hazardous damages. Cleaner technologies, cleaner or greener technologies. Cleaner technology is a slightly older word. Now we get the greener technologies. Investment in appraisal cost. This is not given in the suggested answer. Not just the prevention cost, even appraisal cost. Monitoring aspect. And reducing future risks. Reducing future risks and long-term costs. Reducing future risks and long-term costs. Okay. Part C talks about discuss the gatekeeping role of management accountant in promoting ethical, transparent, and sustainability focused decision making following environmental accidents. Right? Sorry, following environmental incidents. Discuss the gatekeeping role of management accountant in promoting ethical, transparent, and sustainability focused decision making following environmental incidents. Management accountant as gatekeeper. Part C. Management accountant as a gatekeeper by ensuring that environmental and sustainability costs are acts as a gatekeeper. Management accountant acts as a gatekeeper by ensuring that environmental related costs, environmental plus sustainability related costs are fully identified and classified. Fully identified and classified. We did a full identification based on the given information. Fully identified and classified, including opportunity costs such as loss of contribution, including opportunity costs. We got that, right? Including, we got the opportunity cost here. Can you remember? In lost contribution was an opportunity cost. Including opportunity costs, such as lost contribution, ethically and transparently reporting, ethically and transparently reported, ethically and transparently reported, preventing understatement of environmental failures, preventing understatement of environmental failures. He is to challenge decisions that prioritize short-term profit at the expense of long-term sustainability. Short-term profits we may look at by not going in for these preventive costs and all, but long-term value creation and long-term reputation, long-term sustainability. Challenge decisions. Short-term value creation is not what we are looking at. Short-term profitability versus long-term sustainability. Okay. Last point, embedded into future planning, such as capital investment appraisals, risk assessment, and performance evaluation systems. Embedding into future planning, like in these decisions that we are making. Example, capital investment decisions, capital investment decisions, risk assessment and performance evaluation. Risk assessments, performance evaluation systems of KPIs and all that we implement on that. By doing so, the management accountant safeguards the stakeholder interests, support ESG objectives, and ensures that only decisions aligned with sustainable value creation pass through the organization's decision-making gate. So that you can just explain. Okay, so there are a few more questions in the pilot paper. We are going to look at those as well.